Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And this episode is brought to you by ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307 264 9441 or by email at ian@arcsgo.com and make sure to tell him that Commodity Culture sent you. And today's guest is an analyst, investor, trader, and veteran of financial markets who's been active in the market since 1995. He is also the founder of Midas Touch Consulting. It's Florian Grummes. Great to have you back on the show.
Thanks, Jesse, for having me. Pleasure to be here.
Yes, pleasure to have you back on. And I want to start with a broad question. You can take it anywhere you'd like in terms of your answer, but I'd like to know, what are the main themes and trends in financial markets and the economy that you think investors should be paying attention to right now?
Right now, the main theme I would pay attention to is sell in May and go away and enjoy the summer. So it's really astounding for me that again every year people don't want to face the reality of this 120-year-old track record, which basically says volume is going down in the summer, people doing something else. Institutional traders trade less. They also have a family where they want to spend some holidays together with. Rich people are traveling, spending their money in some fancy places, in nice islands. And you just should take it easy over the summer months and not chase the markets. And that's something that apparently is still difficult for many people. So I've been personally facing a few very intense discussions from people who strongly believe, like, no, the markets has to go higher and the Chinese are buying and that's why gold has to go to the moon now. Or no, all the Bitcoin ETFs buying like crazy and that's why Bitcoin has to go higher. No, AI will take over the world and that's why the AI tech boom will continue over the summer months. The probabilities are actually rather low that you're missing out a lot on the upside. And that's my take. And I'm trying to bring that over for the last 1.5 months. I think I've been so far spot on because gold is going basically sideways to nowhere. Same for Bitcoin. And also you can see that the rally in the tech stocks in the stock market is kind of like losing momentum and kind of stalling out. Some of the European indices are already rolling over. If you look at the German and the French index, for example. So that's one of the themes that I currently really want to make people aware of. We have a strong seasonal pattern. Sell in May and go away, but then, of course, don't forget to come back in September, October. I think we might see really interesting entry points again in a few months. So that's one of the main topics. I still believe that in the bigger picture, the trends are in place. We have liquidity expansion basically happening overall, with some breaks, some pauses in between, maybe even some crazy crash moments at some point. But overall, of course, central banks expanding their balance sheets and creating more money, so-called printing money. And that will push all assets higher. And the hard assets like gold and silver, precious metals should do well and at some point also outperform stock markets. But we are not there yet at the moment. It's rather time to be a little bit cautious. Summer months, I don't think you miss too much on the upside, while the risk to the downside, in my opinion, could be actually huge. And if it ends up to be just being a sideways consolidation, little pullback, 5 to 10% kind of market situation until October, okay, perfect. Then nothing has happened. But I think there's also more and more risk growing that we might see actually a sell-off at some point, because stock markets are getting absurdly overvalued, and the breadth in the stock market rally is extremely shallow and extremely unhealthy. It's basically driven by very few stocks, if not just one stock, Nvidia, and I think it's very unhealthy. And if that thing turns around and corrects and sells off, it will affect all the other markets too. So precious metals investors who believe that this will then be the time immediately for gold to go to the moon, I think will be wrong. If we are having a liquidity crisis, everything will go down first. That will create enough pressure and pain in the streets, and that will then also mean that the Fed will have to jump in and print money, and that's the point where then you will see gold and silver really skyrocketing. But I don't think we're there yet at the moment.
So sell in May and go away. I can tell my wife that's the reason all my uranium stocks are down right now. Um, Now, do you think this could then present a buying opportunity, which you touched on? If we do see a sell off in the broad market, obviously that's going to trickle down to the commodities space as well. How do you see the broad market playing out as well? Because as you mentioned, it appears to be extraordinarily overvalued at present. We're seeing Nvidia, Microsoft, Apple, Tesla, Google, Meta, all of the so-called Magnificent Seven continue to perform exceptionally well. They've pulled back a little, but all in all, seem in any sort of correction seems to just be kind of blips on the radar as they then return to all-time highs. So do you think there could be a buying opportunity for gold and silver and perhaps other commodity stocks if the broad market sells off? And what would it take? What would be the catalyst for that broad market sell-off to occur, in your opinion?
Right. Well, Jesse, the tech stock sector is extremely overbought. To bring prices up to where we are now, somebody had to buy over the last 1.5 years, right? And it's not just one person, it's probably a lot of person who bought, and a lot of funds who have bought, and a lot of hedge funds who have bought, and a lot of institutional players, whoever. And all of them are sitting on gains, and it doesn't take much to start a profit taking event, you know. And then at some point, maybe more and more people want to leave the room, and then realizing that, oh, this is just a very small exit door, and lots of people want to get out, and then you can see these hefty kind of crash, kind of sell-offs happening rather fast. And then if you then see the next recovery attempt is making a lower high, and then suddenly it's becoming more and more obvious that maybe the trend has shifted. I mean, this is a process, right? This is not taking one day. This is a process over days, weeks, months. But at some point, then the sentiment shifts. Then maybe you have bad data coming out. And as we've seen already in now Europe, the ECB has lowered interest rates already. All what the market is actually constantly expecting the Fed to do since a year or more, the ECB has done it already. And what was the effect? The German market is down. The French market is down. It's not what everybody expected. They lower interest rates and then more liquidity, and the market is booming again. So that could be the way forward, that once the trend is turning due to profit taking and then less liquidity is available, and then suddenly more and more a downtrend established until there's more panic in the street, and then the Fed actually starts to lower interest rates, and then the market actually thinks like, whoa, it's really that bad that they now have to lower interest rates. Oh my God, let me get out of here. And that's usually what happened. And if we remember 2008, I think it's been pretty much like this. I mean, we had two shock moments back then, the bankruptcy of Bear Stearns, which interestingly enough marked the top in the gold market back then, right? I mean, that's like, sell the news, right? Gold went up, and on the day the news was announced, Bear Stearns was bankrupt, that was the top in the gold market. So markets are counterintuitive. It doesn't need to make sense immediately. You have to think about 2 or 3 corners until you maybe figure out what's actually going on. So we have a lot of problems in the commercial real estate sector, continuously brewing, continuously being there. We've seen, I think, 2-3 weeks ago, there was another bank having issues. We've now seen the issues in the Japanese financial markets. There was one big, I think the 5th largest bank, saying better now liquidating all these risky positions than in a situation when there is no more liquidity and no money available anymore. So it's like who moves first probably has an advantage. So I think there is a lot of things that could happen rather quickly and create a lot of stress. And in such a situation, when suddenly there's no liquidity anymore, there is nobody buying gold and silver as a safe haven initially, because people just running out of money. And like if you get a margin call, you will sell your gold GLD ETF to raise cash to keep your stock position. Usually that's what most of the hedge funds would do, for example. And I can tell you myself, in 2008, I was up until the teeth with gold and silver mining stocks, believing I'm perfectly prepared for the crash scenario. And it was exactly the opposite, because all those mining shares went down 50% and more within 2-3 months. It was very painful learning lesson to understand that once there is a liquidity event, everything will go down. And the only thing that will go up is the dollar, because suddenly everybody is short the dollar. Everybody has debts to pay in dollars, and they need to come up with dollars. And when there is a liquidity event, dollars are not available. It's not so easy anymore to get credit, to get more margin, collateral, etc. So that's the lesson from back then, and I could easily imagine something similar to be happening again. And remember, 2022 is not far away. It's 1.5 years ago, and in October of 2022, there were only bears. Nobody could imagine how this will turn around. High interest rates, everybody was talking recession, and everybody was very skeptical. I turned very bullish back then, and especially then in next spring, also 1 year ago, a little bit more than 1 year ago, I realized, like, wow, people are still so bearish, even though stock market had gone up nicely. Still, many people try to short the market constantly. Nobody trusted the rally. It's probably, I think it was called the most hated rally. 2023 was called the most hated rally, and now we've seen the opposite. Now you will find no more bears. It's hard to find a bear at the moment. Everybody's bullish. Everybody's raving, like tech stocks going up forever, AI boom, precious metals to the moon, Bitcoin 100K. That's the only thing you hear constantly. So the sentiment has shifted completely, while the reason why we've seen 2022 are still there. I mean, we have high interest rates. It's difficult to get money. I think the little guy in the street probably has maxed out his credit card by now. Doesn't get more credit, doesn't get more margin. Mortgage rates have gone up dramatically. Inflation is still there. Prices are higher. They're not coming back down. I think there's a lot of reasons to be a little bit skeptical here at the moment and a little bit more cautious. But as I said before already, and that was, I think, part of your question, if we see a nice pullback now over the summer months, which would be typical, it would probably be a great buying opportunity into September, October. And I like to have a nice liquidity position in such a setup or situation, because that gives me options. I know that I won't miss too much over the summer months. And then in September, October, we can reassess and figure out, oh, now, nice, look, now everybody's bearish. Sentiment is totally different. Very high levels of skepticism is back in the market. Or you can see, like, the charts are oversold. Lots of things came down 10-15% maybe. That's a great buying opportunity. And then I have the ability to act. If I'm fully invested, I have no options anymore. I just have to sit through any and every correction, pullback, and hope that it's not getting too painful at some point. So that's personally my learning experience. And especially in 2008, I mean, if you've been able to pick up these mining stocks at the bottom in October or November 2008, man, I mean, there was a 10x everywhere. It was unbelievable gains that you could make in these mining stocks. But if you have held them since the top that I described before, from March 2008, if you went fully invested into that crash, it took you a year to just be break even, So by February 2009, when gold was back up at $1,000, you might have been maybe break even. I mean, that's not fun, It's like you didn't make any money in the end of the day. So you had a lot of painful nights to sit through or sleep through during the financial crisis, and then finally you end up break even. I mean, that was not a good experience. So timing is very crucial. And in my opinion and my understanding, most of the mining stocks are not a long-term buy and hold kind of situation. I understand if somebody has kind of the venture capital approach and says, look, this is my allocation for mining stocks, and I want to own 20, 30, 40 different stocks. And I hold them through no matter what, because I know in the end of the day, the probability that at least two or three of these 20, 30, 40 mining stocks will do a 10, 20x. And that's enough for the overall return of the portfolio. I understand that, but that's a different approach. And that's an approach that is very difficult for many people, because you really need to sit on your hands, do nothing, and actually should not watch the markets constantly. So that's one of the reasons with venture capital, most of these investments by venture capital funds, they are not liquid. They cannot liquidate. They cannot check the stock prices every day. But with the mining stocks, you can do it. And if you do such a highly speculative approach, which I just described, and then check the prices every day, it will put a lot of psychological pressure on you. So you really need to understand what you're doing. And my approach is a little bit different now. I don't believe in the long-term buy and hold kind of thing. I believe there's going to be huge opportunities again in the commodity sector, but I need to buy low to sell high, and I don't want to sit through huge pullbacks. That's my personal approach.
Yeah, I recently had Peter Grandich on and I asked him this question, so I'm very curious to hear your answer as well. And that is that for, the past several decades, the prevailing wisdom in the investment world has been that, well, you just put your money into the market broadly, buy an index fund. If you have a long time horizon, you just sit on your position through thick and thin, keep adding to it, dollar cost average, don't try to time it. And over the course of 10, 20 plus years, you're going to build wealth. And this also kind of relates to the traditional 60-40 portfolio, the random walk down Wall Street kind of theory of things. Has the paradigm changed in the broad market, in your view? Has it been largely low interest rates that have enabled this sort of strategy? And do you think things are changing? Are people going to be required to become more active with their investments when it comes not specifically to the commodity space, but to investing in general?
I mean, it's always also a very personal question and preference, right? But of course, I mean, I mentioned it before. If you look at the broad market at the moment, most of your stocks and your ETFs would have done very poorly over the last 1.5 years. It's just a few selected tech stocks, especially Nvidia, of course. Microsoft has done really well. Alphabet and Apple is kind of like coming back, and Amazon, but the rest is actually disastrous in many cases. They went, in the best case, nowhere. Many actually are down. And so if you had a buy and hold approach and picked the wrong stocks or the wrong ETFs or baskets or funds or whatever, it would not be very helpful the last 2 years overall, because 2022, everything was down. So I think you're right when you said that the low interest rate environment was very helpful. And if we assume that at some point we're going back to such a low interest rate environment, then probably in the very long run, those 2-3 years, which are challenging at the moment, might be just a little blip in hindsight. Okay, if you look back in 20 years, oh, that was 2022, the pullback back then, and 2023 and 4, most of the stocks went nowhere. And it's probably just a little blip in the long term, because as we know, they devaluating your currency. And that's reflected then also by stocks going up, real estate going up, most of the stuff going up. And the same is true for precious metals. I mean, if you had held precious metals until today, that was one of the best investments you could have done. I personally love to do it. Physical precious metals in your own hands, in your own vault, or in a vault outside the banking system, in ideally different jurisdictions, because it's easy. You don't have sleepless nights about it, and it's overall more or less constantly going up. I bought my first ounce of gold for $250, roughly 200 euros. I bought it back then on eBay, a Krieger run, because there was no gold available. There were no gold dealers in Germany in 2000. It was very easy to hold it until today. And I think it will be like this for the foreseeable future too. A totally different story, however, is the mining sector. It's been impossible to hold 20 years a portfolio of mining stocks. You need to understand that this is a very cyclical sector that the commodity sector itself is a very cyclical sector, and it has constantly spikes and crashes, and it's not like the broad stock market, which overall is just continuously going up. In the commodity sector, you have these crazy spikes, and then the market comes back down. So yes, I would say maybe over the last 2-3 years, oil investments, some broader resource investments, if like big dividend paying blue chips like Rio Tinto or BHP Billiton, probably that was not so difficult to sit through. But your smaller mining stocks, crazy volatile ride, crazy ups and downs. And even if you caught the run in uranium initially, the pullback quickly 30, 40, 50% are gone if you're not acting fast. This is not happening in the broad stock market, right? So you have to consider this volatility, and that was also one of the reasons, because I've seen it myself in the past. Like you have a five bagger, and 3 months later it's the one bagger, and you don't want this to give it back, you know. So you have to have smart exit strategies, and just holding through, closing your eyes, sitting on your hands, and just holding it through is difficult. If you have insider knowledge and if you have insider connections, that maybe is a different thing in this sector. And unfortunately, for the normal retail investor, it's very difficult to get all these informations. And I'm also way too much far away from where actually the music is happening in Canada primarily. But I know that some people got very rich with these insider trades, and I don't think it's correct. But that's how many people playing successfully the resource market. And if you're depending on newsletter writers and on news from the stock press releases, it's a difficult game, and you need to have a very good timing. And I personally use charts to look for the timing and seasonality cycles. And right now it tells me there is no need to chase the sector. There's no need to chase mining stocks, specifically not the gold and silver mining stocks. I think the easy money in uranium has been done. It's much more difficult now to find. There will certainly be some interesting news stories, but as you've seen now, the market needed to take a breather. And probably the same is now the truth for copper, which had an amazing run. It also takes a breather. I've talked about spikes. Remember, two years ago was the spike in the nickel market when they squeezed some big guys. It took a long time until the nickel market was ready again. Now, I think the most promising sector, because it's so contrarian and bombed out, undervalued, is the lithium sector now. I think that's probably an interesting place to go to now. Nobody talks about it anymore. It came down quite a lot. If you look at a big stock like Albemarle, great company, but it came down from, I think it's down 60, 70% the stock. It's a big company. They even pay a dividend. That's a sector I'm interested in. That's something I would be also looking over the summer months, maybe if there's some more weakness or further pullback. But that's the things that nobody's talking about. And that's probably where the easy money is being made. But chasing a narrative that now everybody's aware of, China is buying gold, and that's why the market went up since February. It's nothing new. There is no surprise in it at the moment. So again, I think we're going to see a good buying opportunity in many sectors towards September, October. But right now, no need to chase anything.
Now, how do you view geopolitical and political events and their potential impact on the commodities market, on the broad market in general? Obviously, we have a lot going on around the world right now. We have the Israel-Hamas conflict. We have the Russia-Ukraine conflict. We have the presidential election coming up in the United States, one of the most contentious ever in recent memory. Do you even pay attention to those things, or do you block that, or is that all just noise when it comes to your investment decisions?
No. Of course, I want to be as good informed as possible, right? And I follow it. I follow it closely, but I don't watch TV. I don't have a TV, so I have only independent sources and material that I look at. I try to distance myself during the day when I trade. I try to not get too much distracted by all these kind of things. But of course, it plays a role. So, I mean, you're talking about the gold market. We had this Hamas gap in early October last year. That was the start of the gold rally back then. When gold closed at 1810, I think. No, it was the low was at 1810 on a Friday. It closed at 1829 or something. And then on Monday, it opened up at 1850 because Hamas had invaded Israel. And that changed the tone of the gold market immediately. And since then, gold had been rallying up until end of May. And it gained more than $630 within 8 months. So that was a big rally. And just by the way, out of that perspective, you need to consider this thing went up the hill, give it a little bit of a pause and a breather, and let it like rest and recharge. You know, if we want to go to $3,000 gold, we want to maybe go at some point to $5,000 gold. You cannot do this in just continuously running up the hill. Yeah, you need to have a break. I think it's totally logical. But coming back to your question, yeah, I think the geopolitical tensions will continue to increase. We have clearly, at best, a Cold War, World War III going on. And we have a lot of proxy conflicts going on. And the situation in the Ukraine is a mess, is complicated, is unfortunately at a level where it's, I think, getting dangerous because the NATO, the Western alliance, led by America, has been pushing continuously, refusing any diplomacy, refusing any negotiations. Hundreds of thousands of people have died. The Russians have a clear security interest here. I think that NATO, in the end of the day, is responsible for this conflict, even though the Russian invasion was not correct. But it is understandable that the Russians have security interests close to their border. It would be the same if the Chinese suddenly placed their rockets in Mexico in front of America. The Americans would freak out as well. And they did, by the way, in the 1960s with the Cuba Missile Crisis. So we have similarities in the history, and people don't want to listen. I see that the press here in Europe and Germany is very aggressive towards Russia. Of course, the Russian press also is very aggressive. And this is not good. And nobody can lose their face anymore. Huh? The risk for Russia is basically losing everything, because if they give up here, that probably step by step will mean the end of Russia. And for NATO in the West, if the stakes at play are so high now, if they would pull back now, they would also lose their face, and that could also mean the end of the NATO alliance at some point, because people seeing that it's not worthwhile joining that group anymore because they overplayed their cards, maybe, whatever. So it's very tricky. I hope there is a way out. And I think right now the war economy that is going on in many parts of it, like for example Germany producing weapons a lot, you see the stocks of weapon manufacturers doing well. That is of course somehow stimulating the economy to an extent, and that has also been a little bit inflationary. But I think once the war starts, should it be starting in earnest, and God forbid, I hope this will not happen, but this will not be a good event for the markets. And that is only one conflict. You mentioned the others. Taiwan, I think if China invades Taiwan, it's going to be a complete crash, a complete disaster, an implosion of all markets because of the semiconductors. The silicon shield that has been built in as a protection of Taiwan means that, I mean, all the gear that we're using right now, our conversation would not be possible without semiconductors. Everywhere they are part of our normal life now, and with AI even more in the future. I mean, it's unbelievable how dependent the world has become of these semiconductors made in Taiwan. So if there's any issue over there, that will mean probably immediately a massive crash in the markets. And again, that would be a liquidity event. And again, that would also affect your gold and silver prices. Hopefully they will find a way out. But of course, studying history, we know that once there is a hegemony, more than a century-old hegemony, and there's a challenger coming, in this case it's China, uh, these kind of conflicts never ended peacefully. We don't know how this will play out. The current presidency in America certainly has created much more tensions and didn't brought any solutions to it. We see the end of the globalization in many forms, which is on the one hand inflationary because it has creates issues on the supply side. Many of the resources are coming from Russia, some of them like oil coming from the Middle East, from Africa. And now it's like you have to pick the side. Are you a friend of America or are you a friend of China, Russia? Which then means resources become more tight. And that's also one of the big arguments that why we are in a commodity supercycle, right? And generally speaking, I believe we are, but it's not going to be a steady line up like you know it from the stock market, the general stock market. It's going to be crazy, kind of roller coaster with massive spikes. And then if you don't take profits at that point, you will quickly give back all your profits. So the geopolitical tensions are playing a big and important part, and you have to monitor it constantly. But it's also a black swan kind of thing and hard to predict. So it's very challenging, but we have to factor this in constantly, of course.
Let's talk about silver for a moment here. It's probably the most beloved commodity by viewers of this show, but it feels like sometimes it's a love-hate relationship sort of situation in that people get very frustrated with the metal because so many of the catalysts are there. As you pointed out, and I think this is the case for most of the time, is that the market can remain irrational longer than you can remain solvent. I think that classic phrase makes a lot of sense when it comes to the silver market as well. So I wonder what your current outlook is for silver. Obviously, very far off the previous all-time highs, as well as when it touched close to $50 in 2011. It hasn't gone anywhere near that. Uh, and there's one side question I want to ask as well, which is silver in solar panels. This is another piece of the thesis that's being kind of paraded around. I've spoken to guests who are very much believers that solar panels are going to be a massive driver for silver and one of the reasons why they expect silver to go up. I've spoken to others who say, well, the renewable energy, green energy revolution is basically a scam. And in the end, it's all going to collapse. I've talked to people in the middle. Where do you stand on the silver usage in solar and also your just general outlook for the silver space?
Yeah. Okay. So when it comes to the solar panels, there is no doubt that there is massive demand from the industry, especially in China and India at the moment. I don't personally believe too much in solar panels. I mean, I like the fact that I have a little gear that I can carry with me and I can recharge my phone in case of a catastrophic event or like a backup plan, right? I like that fact. Do I want to have solar panels on my rooftop? No. All my friends that I've done it here in Germany over the last 15, 20 years with massive subventions barely come over with a profit. It's very tricky. It's all only working because the state is giving a lot of subventions here. This is never a good idea in a free market kind of approach. They just talking now, the village where I'm living, they want to put in front of the forest, the whole place, they want to put solar panels. And there's already movement in the village saying, no way you're going to destroy the nature over there, right? So I personally believe it's most of it, wind and solar is destroying actually the nature. I think most of it is a scam. It's not making our place a better world. But I understand there's different views on it. Fact is, silver is trading with a massive premium in Shanghai. Still, until today, 12, 13, 14% premiums usually. So that gives the opportunity for arbitrage trading. And that also has been putting a floor below the prices in silver and also below the prices in gold, right? I think silver will always do what it always does. It is following gold until finally it does its own thing for the last stage of the bull market or of a bull cycle. And that's what we've seen just very recently. In April, finally, silver showed up to the party with its own behavior. It didn't care anymore about what gold was doing. And it broke out above $30, which was a good bullish move. But in the end, where we are now trading slightly below $30 again, I have to tell you, it's not like super impressive what silver has done, right? If you go back to October, we talked already about it, 1810 in gold, there was the start of the rally at 6th of October. Silver started, I think, around $22, something like this. So overall, it gained more than $10, more than 50% in 8 months. That's a massive move. That's a respectable, very good move. That's it. It's fine. But when it shows up and does its own thing like it did in April and May, it's a warning signal from my experience. So, and as we now know, yes, markets have been going nowhere. Silver is down from the top 12% peak to drop. Gold is down 6%. The mining stocks, the normal ones, are 12% down, and the junior silver stocks are down more than 15% already from their top. Not a big thing, but then again, ask the people who bought at the top, probably doesn't feel too well already. So I think it's totally normal cycle as it looks like. So now it's up to gold again to start the next leg up at some point, and then silver will follow until you are way into the next run up, and then silver will show up again and do its own thing. And in the bigger scheme, maybe we need another two or three of those kind of minor cycles. And in the large cycle, at the end, silver will have 1 year in the sun where it's doing constantly its own thing, and it will probably break above $50, go to 100, 200, who knows? Definitely, I think we're going to see three-digit silver at some point. But it's going to be driven because the sentiment is super bullish in the market. People have been watching metal prices going up for years. Everybody's believing in it, and then the smaller nominated silver, you can buy 1 ounce, is much cheaper than gold. People probably will look like, oh my God, gold now $3,000, $4,000, $5,000, silver only $50. Let me buy silver, and then you're going to see the little brother catching up and then taking over gold. And then if you do the final calculation at the end of the bull market, you will find out, wow, silver outperformed gold by 2 or 3. And probably that's how it's going to be this time again as well. It's a byproduct of many other mining procedures and processes. Yes, I know there is not too much physical silver left, and I definitely believe it could happen at some point that we get a silver squeeze. But I also think that people have too much hopes into silver, and just should treat it a little bit more rational. I'm a silver bug myself. I can tell you that most of my physical holdings are in silver. It's actually more than half of it is in silver. But I've been accumulating for the last 20 years, and I see the chance in silver going to 3 digits. But as we have learned now, it takes time. It takes much longer than we all anticipated in that sector. Because for some reason, in a fiat money system, the central bankers and the politicians can kick the can down the road for much longer than we all can imagine. And the truth is that 95% of the people around us are busy with their little 9 to 5 kind of lives, paying the mortgage, watching football in the evening with a bottle of beer, having an argument with their spouse and taking care of their kids. And that's already a lot of things on the table for one day. And then worrying about the financial system and running immediately to change all your paper money into precious metals is not very high on their priority list. And when this collective realization is going to happen that we are in a paper money, Ponzi scheme, fake kind of system, it might take even more drastic events, going back to, and that's the classic comparison example, the German hyperinflation 1923. You have to remember how much it took to destroy the confidence back then of the people. I mean, it was, first of all, I think 2 decades constantly fighting back and forth between the German, the British, and the French press. Then you had the introduction of the Fed in America. You had the First World War with terrible new weapons. People have never seen before such a cruel war. Millions of dead people. Then the German emperor had to leave. a system in place for 50 years or even more had to go. A totally new democracy, but it was a complete disaster for many years. The printing, the invasion of the French taking over, and then finally it came to the hyperinflation. I think the level of pain that the normal people had to endure until today has not been in any form to be compared to what happened back then. So that's why I think there's still a high level of confidence in the system. And you don't see that collective realization that we are living in a fake world, basically.
Very fascinating thoughts, and this has been a great conversation, Florian. Thank you so much. For those who want to learn more about you and your work, talk to us about Midas Touch Consulting and anywhere else you want to direct people online.
Yeah, Midas Touch Consulting. We are independent financial advisors, consultants. I publish regular analysis on gold, silver, and also Bitcoin and digital assets. I primarily trade my own money, actually, so I don't sell any newsletter. But I'm very much interested in helping people because I know how difficult and challenging investing and financial markets are. I believe giving is receiving, basically, and it helps me also to focus myself constantly. And people can go to my website, which is midastouch-consulting.com. We also have a free Telegram group where you can join us. It's a network of investors from all over the world. We're exchanging ideas. So that's, for example, one of the places where I get my news. People are welcome to join. I have even a daily call on gold where I give a little bit of orientation where we are in the short term. And as I said, we have weekly research, in-depth gold, silver, and Bitcoin analysis. Lots of charts. I believe that looking at a chart, you basically get most of the information already. But I look at everything and I'm always open-minded. And as you heard, I'm currently interested in lithium. So I think you need to be open-minded in this world very much, yes.
Great. Well, I'll put a link in the description to Midas Touch Consulting for people who want to check that out. Thank you once again, Florian, for coming back on and sharing your knowledge with the audience.
Thank you. Thank you very much. It's been a pleasure.
And thank you for joining us today. For all of your precious metals needs, be sure to check out ARC Silver Gold Osmium. Contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.